is based on $52 per barrel. And that's our FY20 projection, correct, Lydia? Support. Thank you. Net asset value, finally, everybody, is above $25 billion. As of this morning, JP Morgan is giving us an intra-month number of $25.107 billion. So congratulations to all of you. Yes. And as we all know, that does make a difference when it comes to distributions to the state. When you take into account our rolling average over a period of years, the net asset value is what governs what we are able to distribute to the state. So we do like to see it increase. It's not just that we want the number to go up. Severance tax permanent fund contributions, some positive news. As all of you remember, the legislature passed Senate Bill 535 this past year, putting a cap on this year's capacity for bonding, severance tax bonding, capping it at $181.8 million. This means we should see a very nice transfer in a few weeks of about $175 million to the severance tax fund. Timing can vary. And that bill also assures us of an annual inflow of $23.7 million to that fund over the next 10 years. We're grateful for that. Looking down my report to item C, you now see the August meeting dates and times for the committees and the council. As you all know, we take July off. Your staff doesn't. Many of you don't. But we will have no meetings as of now scheduled for July. We'll be back here in August. I think it's important to mention that we are hiring for several positions in the office. Vince is hiring an investment strategist. We have located a very competent individual and hope to be able to make an offer this week. Hope to be able to. Charlie is sourcing an analyst for all three of the areas that he's responsible for. He's receiving his lists from the state personnel office and reviewing them. We're looking for a New Mexico private equity portfolio manager, as well as a financial coordinator for Brent. If any of you would like to see these position descriptions, let us know. And if you have ideas of highly qualified individuals that might be interested, please tell us about them. Vince, do you want to mention Bart, please?
Well, as you know, we had Bart Stuckey moved from the strategy team to the fixed income director spot. We did that on an acting basis while Bart got his feet wet, and we've ripped the acting label off of Bart. He is now our full-time fixed income director.
Congratulations.
And just one university to mention to you under external relations, and that's Highlands. We currently manage about $4.7 million for the Highlands University endowment. Charlie and I have been asked to present to the Highlands University Foundation on the 1st of July because they're considering moving their funds to us. So we're looking forward to meeting with them. Governor, that's my report.
Great, thank you. Any questions? Yes, Senator.
Just maybe a clarification, maybe with your end too, but was the $175 million that we're expecting in a couple of weeks, did that take into effect any sponge bonds, or will there be sponge bonds on June 30th, or what's the plan?
Governor, yes, there will be 2 sponge notes, a supplemental sponge note, a little less than $20 million. And then the senior sponge note, I believe it's in the $60 million range, but I have to confirm that. So there will be 2. And the reason that there will be sponge notes is because it was authorized by the unissued project. So whereas there weren't any new additional capital projects funded with severance tax bonds this last legislative session. There's a list of authorized but unissued that just weren't ready to go in previous sales, and they're ready to go now. And then there are also 2 earmarks that are just always funded, and that's the tribal infrastructure fund and the CONUS project.
So we won't see anything, it'll all get sponged up, or will any of it drift over here?
It will, yes, there will be a large transfer of $175 million.
Okay, the 175 is the residual.
Is the residual, yes.
So how much will sponge bonds be?
One is about 20 million, and then the senior, I think, is about 60, but I'm sorry. I'm on vacation, and I have vacation brain, let me get, I'll
No,
get
but
it to
that's
you.
okay,
at this meeting.
just
You got to go on vacation, how did that happen?
That's all right, thank you. Thank you, Governor.
I'll find it.
Thank you, Senator. Is that it? Any other questions or? Okay. Thank you. We're gonna do the real estate and real return, all right? Fine, then, let's go.
All right. Well, before I get into this, the report, the actual report, if we go to page 16, RDK brought home some new awards for themselves, and maybe I'll have Marcia tell you about that.
Well, we received a leadership award, quality leader award for the 2nd year in a row. This award's been given out for a year, so we're the only ones who received it 2 consecutive years, so we're proud of that. We're also proud that this doesn't come from our peers, this actually comes from our clients on the quality of our services that we provide. So we're very proud of the honor, and I'd like to say that I think between Matthias and Janelle, we even have an A team from our PK working on you. Matthias wouldn't even say that. But we were very honored, and at first I said, well, 2 years in a row, that's great. How many years has this award been given? And that's when they said 4 years, and we've been 2 out of half of that. We were pretty proud. So
Congratulations.
thank you.
We participated in that, as Marcia said, it's a client-driven survey, 15 or 1,800, I think, institutions like us that participate, or people within institutions that participate, and we participate in that each year. It's a good, solid survey. It's a real investment. Okay, well, maybe flip to 17. I'll start by saying we have been really busy in the portfolio. So first, thank you very much for the new the approvals of the new asset allocations for tobacco and water. Those 2 funds will be rebalanced on the first business day of next month. We're already in the markets making the changes we need to make there. So we can move all the money on the first. We'll be fairly close. We'll have a little bit of trouble in the non-core fixed income. Those are all private funds, a little bit tougher to get into. It'll take us a little bit of time to get all the money when we get to the non-core fixed, but right away we'll be able to get the rest of the markets as you allocated there. We'll have the tax stabilization reserve fund invested also on the first business day of the month. We're not in the markets yet for that one because it's all cash. We'll just put that into the appropriate funds and in turn those funds will get the money invested over the next month or 2. So we should be pretty close on that. That also has a non-core fixed income allocation that may take us a little bit more time. But for the rest of the fund, we'll have that invested very likely within July. Certainly no more than probably September, but we should have that invested up. We've also done some rebalancing activity in land and severance to get you toward those long-term targets. And I've got a recommendation to shift from your current interim all those to your long-term targets. So we kept moving the bar. I kind of got you close. I think I'm going to have you there. Time after this, I've been coming about every 9 months to a year to recommend a change to the interim closer to your long-term. And I think the next one may do it, but we'll go through that here in a little bit. So lots of rebalancing activity. Now we did bring you one item. It's 3D on your agenda. That we thought a little bit about. It's not quite a true rebalance that you all have given us authority to do. It's really taking money from an underperforming manager with no defined spot. It'll stay on the real return portfolio, but we're not rebalancing from one manager to another or from one asset class to another, so we thought we might bring that for a vote. Otherwise, all the other activity is just straight up rebalancing that you've given us policy authority to do. But back to the performance report. If you're looking at upper right-hand box, we normally start there. Your allocations are quite in line. Again, that fixed income, core fixed and non-core, still with an imbalance there. That's just trying to move that money to less liquid in private markets and non-core. So it's happening, but a little bit more slowly than I'd like. But May and June, we'll see improvements there in those numbers. Severance tax also quite in line. It's a little bit more of an underweight to U.S. equity there. That's not anything more than normal movements. And because of, if you all approve the interim benchmark change, we'll be rebalancing overlay and severance based on that. And we'll try to get those a little bit closer during that rebalance. We try our best to stay out of the markets. It's expensive when we go trade stocks and trade bonds. So we do as much as we can to stay out of the markets and avoid those costs. If you drop down below, you can see for the 1 year and in, returns are starting to weaken relative to the 3 years and out. We made a new high in the stock market here the last couple of days, and there's a significant expectation of a Fed rate cut next month that could keep this thing going a little while. But it is late, as we've been talking about. Now, while stocks made that new high, since the blow-off peak in early 2018, in fact, it was January 26, 2018, the market had this kind of blow-off for a couple of months, and it peaked on that day. From that day through yesterday, stocks are only up 4% annualized for that 17-month period. So that 17-month period, we're only up 4% annualized. Half of that's a dividend yield. So price of stocks are only up about 2%, a little bit less than 2% for 17 months. I think it's really good stuff. The foreign markets peaked at the same time on that January 26th. They've not recovered. So Germany, France, Spain, Italy, the UK, and Europe, all the Asian markets, the Japanese market, none of those have recovered back to that January 26th high that the global stocks peaked. We're starting to see, or have been seeing, some deterioration in the global economy. Most of my indicators that follow those things are down and have been down. And it's across the board. It's the interest rate sectors, manufacturing sector. The manufacturing PMI here, the Purchasing Managers' Index, which is the major measure of manufacturing in the country. That index is centered on 50. When it's above 50, manufacturing is expanding. When it's below 50, it's contracting. That's about 50.2 was the last print, down from about 50.7. We had seen it 54, 55, even 56 a year and a half or maybe 2 ago. So it's really been declining. And we think that might sink into the recession, that portion of the economy sink into the recession in the not too distant future here. Like I said, the Fed, there's a expectation of the Fed will start cutting interest rates. They're 2.5% now. Don't have far to go. Back down to zero. But we'll see. The market's expecting a rate cut in July. We'll see if that happens. I'm not entirely sure what the Fed will accomplish with it, though. Only about 9% of mortgages in the country are floating rate. So have adjustable rates, which Fed cut would help. Student loan debt's typically floating rate, so maybe there's a little help there. But corporations are as indebted as they've always or as they've ever been, and we talked about that. The bond market is twice the size that it was in 2007 at the peak of that economic expansion. And since this current cycle started, the economy is only about 25% bigger. So the bond market's doubled. The triple B portion of it's quadrupled, and the economy's only up about 25% in terms of size. So corporations are really quite indebted at this point. Do interest rate cuts really help them? I'm not entirely sure. 0% auto loans are already out there. 0% credit cards are out there. So I'm just not sure in terms of the real economy how much a Fed rate cut could help us immediately. Financial markets probably be up a little bit. Typically, when the Fed makes its first rate cut of a rate cut cycle, stock market goes up a little bit, bond yields go down a little bit, so bond prices go up, and currency falls. So we'll see if we get the same pattern. But I'm just not seeing where the big bump to the real economy could come from Fed's cut interest rates now, based on kind of what we're seeing, what's happening out there. So our numbers are starting to decline. You see the 1 year 503, a little bit of underperformance creeping in to the portfolio. You know, we're fairly defensively positioned. This is April. April was quite a good month in the stock market, so not entirely a surprise to see a little bit of underperformance there. If you'd like to see where it's coming from, flip over to page number 21 in your book. And you see the preponderance, it's the lower right-hand side of that chart. The preponderance of the underperformance is the U.S. equity portfolio. And as you know, that's fairly defensively built, so no big surprise there. There is some underperformance in the non-core fixed income, but if you recall, that's mainly a function of a mismatch in the index versus the portfolio. So the index updates in real time, portfolio is 1 month lag. So anytime we're in an up market, portfolio will lag when we get performance. So if we get to a down market, it would outperform. We did fix that, but it won't. We didn't do anything on a historic basis, so it's going to be a go forward basis. So it'll take a year or so before it's fully reflected in this chart. Let's see. I think that's all I had planned. Marcia, Matthias, anything you wanted to say on performance?
Just repeat, the NLPs were down for the month, but 19% on the calendar year today, but that's less than 2%.
We can wrap it.
All right, any questions, comments? All right, thank you. Seeing none, we can move on. 2B. Oh, Paul's coming up to the table.
And Seth, but no Jack.
Morning, Seth.
Did Townsend win any awards? Seth? Not this one.
Oh, I saw that.
Presentation over. That's how it works here. Highly competitive bunch.
Okay, just kick it off. Sure. So I'm going to talk here about both real estate and real assets quarterly performance. As you'll see in your report and materials in front of you, this is fourth quarter performance. So I know we're just about halfway through the year. We're talking about performance that was almost 6 months ago now. So there is a significant performance lag here. Typically, it's not this long. There's always typically a quarter lag. Here at year end, we went through year-end audits with each year individual manager. Then they report to us, and then we produce a report for you. And just based on the timeline, we didn't have the report ready for the May meeting. So we're here to talk about year-end performance in June. So unfortunately, that's where we're at. But I'll sort of include some of the more relevant recent performance in my materials that I'll talk about. So I'm not going to split page by page, but I will refer to the number of pages in the presentation. I'm going to use the bottom right-hand corner page that's in the Townsend presentation, because I know there's a lot of page numbers in some of the materials. But sometimes when we report these, when we give this report, and we dive right in without much background or explanation, we, Townsend, and your staff live and breathe this information on a daily basis, so we're used to the terms and some of the information. So I'll take it a little bit higher level, back up a little bit, and do more of an overview summary without getting too much into the weeds. There's a lot of detail in this presentation. We give it to the year end. We do fund summaries on every single investment in the portfolio, both in real estate and real assets, so those are included in the back. But I'm not going to go into each one of those. Happy to answer questions at the end. So annually, there are 45 positions in this real estate portfolio, thousands of individual actual underlying assets within those different positions. And those are, again, those summaries are in the back. First, the real estate allocation is 12%. This number has 12% of your total plan. This number has increased over the years. There's as low as 5% target allocation in 2010. So almost 10 years later, we're more than double that. And on a funded basis, we're at 9.6% of total plan assets. So that's your net asset value of real estate versus your total plan, about 9.6%. So under that 12% allocation, which is why we continue to make new investments in the portfolio. When we include unfunded capital, so there's a number of funds that we commit to that are drawing down capital, we're closer to that, we're actually at 14% of the allocation. So we're over allocated a little bit, which is where we want to be to get there on a funded basis. This also represents an 80 basis points increase quarter over quarter in our allocation, and that's somewhat misleading, but also a result of the volatility in the equity markets in December. So as you recall, in December, the equity markets were down, and the total plan was down. So as a result of that, our real estate allocation jumped by 80 basis points. So not the way we want to grow our allocation by any means, but is the result of that change. The real estate portfolio did increase quarter over quarter by $55 million. That is net of all new contributions going out to make new investments, distributions, income received back from these investments, as well as appreciation, undistributed income, as well as fees.
And two significant things are happening in the real estate portfolio that'll take us probably to 12% funded. We had a rebalancing addition to our portfolio that we were about to get deployed. I think Vince made reference to that a minute ago, and we're going to get proceeds from the tax stabilization reserve. And those two funds, as they come in and get deployed into open-ended funds, will get us up north of 12%.
So moving on to performance, this is highlighted in a graph on slide 7 of the Thompson presentation. From a performance perspective, given real estate as well as real assets are longer-term liquid asset classes, we focus on longer-term performance, typically 5 years or longer. We do have shorter-term performance in here as well. This is, again, shown on slide 7, where we show a 10.9% return of the total real estate portfolio versus a 9.4% for the benchmark. So strong outperformance over that 5-year period. You can see the outperformance over other periods as well. To make this chart a little more complicated, there's a third bar in the middle. This third bar is defined as new commitments since 2011, where we showed this, and we call commitments before 2011 the legacy portfolio. We do this because in 2011 there were significant changes here at the SIC, both internally and externally. This included new staff, a new board, new consultant. Steve, Vince, and Townsend have been working together since that inception. Paul joined in 2016, as well as other real estate staff members in between. So we implemented a more formal policy in 2011, an approval policy, an allocation policy, and stated objectives. They're all outlined also in this, later on in this presentation, back on slide 20. But as you can see, the rebalanced portfolio significantly outperforms over all time periods. Today, this portfolio represents approximately 96% of that total net asset value I referenced earlier. And the legacy portfolio continues to be prudently liquidated. There's not a forced sale. There's not, let's dump all the assets. These are being prudently sold in the market. Those are highlighted on slide 15 and 16 in the presentation. Third, we talk about core and non-core allocation a lot. We target a 55% core allocation, 45% non-core. Within core, this represents high occupancy, stable asset classes, typically invested across the 4 primary property types: retail, industrial, office, and apartments. These are typically invested in larger, more liquid markets. These investments are designed really to provide more of a return from income, and less from appreciation. Approximately 70% of core real estate is return is driven by income, with a balance from minor appreciation. This also typically comes in an open-ended fund structure, so we're able to add capital to these funds as well as pull capital out, as long as those funds have the ability to create liquidity. The non-core portfolio, the 45%, that's the 45% allocation, it ranges from minor rehab to light touch value add redevelopment properties, also ground up development. These are global assets, global portfolios. These are closed-end, so once we commit to these funds, we're locked in 8, 10, sometimes 12 years. Where we monitor the investments, but during that time period, the manager is buying, creating value, as well as selling those assets into the market. These property types in the non-core portfolio include those primary property types, but also includes the specialty property types. So we have exposure to medical office, senior housing, self-storage, student housing. So these are considered more alternative property types within real estate. Before 2011, again, that legacy portfolio was 100% non-core exposure. So there's no true beta exposure in the real estate portfolio, so very limited income was coming off of that portfolio, and it was also impacted during the global financial crisis to a greater degree for that reason. So another reason for that underperformance. Today, the portfolio is 61% core, 39% non-core, slightly above on the core allocation versus our 55% target, but comfortable where we're at today, given the exposure we have. Lastly, Townsend is your consultant. We perform a number of tasks on your behalf. So we monitor investment performance, but ultimately you, all your staff, ultimately make the decision to invest and negotiate final legal documents. Townsend we meet with hundreds of managers across our global offices throughout the year. We screen different opportunities based on performance, based on our due diligence. We do deep due diligence on many of them. By the time they come to this room, the manager's sitting in front of you. They've been through a number of iterations of underwriting due diligence. Townsend's investment committee approves all investments before you all see them, as well as your staff doing their own underwriting. Lastly, Townsend has negotiated some terms and fees ahead of time on your behalf and across all Townsend clients' behalf. And this is shown on slide 8. There's a number of different examples there where the SIC has benefited from Townsend's broad client base, resulting in about $2.4 million in fee savings across your portfolio. These are the different fund names listed on the right hand side. Those change quarter over quarter. That's an annual fee savings to the SIC. Importantly, Townsend in no way benefits from these fee savings. 100% of our Townsend revenues are generated from clients like yourselves. As stated there in my opening remarks, there's a lot of more detail in here. We have significant events on slide 9 showing additional monitoring that we do throughout the portfolio. As I mentioned, the legacy portfolio is outlined back on slide 16 and 17. And then there's also a compliance matrix I want to reference on slide 20 that gets into that the investment policies and the performance in the strategic plan that we operate under, and we are in compliance with our strategic plan investment policies as of year-end. So I didn't want to go into any more detail than that, but happy to answer any questions from the assistant.
Are there any questions, comments based on the presentation? Yes,
Just for
Mr.
my,
Treasurer.
just for my own information, on the liquidation on that student housing.
Mhm.
Tell me what that process is. For you.
Well, so student housing gets leased once a year, and if they don't hit their numbers because there's something going on at the university, in fact, in that portfolio, there was one university that lost its accreditation, so they had a very difficult time with enrollment, which meant that the student housing occupancy moved anyway. So, typically the leases are signed over the summertime, you look at occupancy, and then if you've got strong occupancy, you sell the building. So they're just picking the ones that are stabilized and holding on to the ones that need more work and more time. But we believe the manager's working very hard on getting rid of those final assets.
And that's on page 53.
Yes, in the
16 of your report.
Correct. So that they've been operating under a planned liquidation strategy for the last 3 years. They actually are no longer charging any fees to investors. We're not paying anything for this anymore. So obviously an underperforming fund for us, but they are prudently again.
Any other questions or comments? All right, thank you both very much, and we'll, it's okay this time that you don't have a
Award.
Don't repeat.
I will talk briefly about real assets as well. So this is also in your presentation, in the materials as of fourth quarter, due to the performance lag. So this is a real asset / real return portfolio. The real return portfolio represents 12% again of the total assets. Real assets specifically is about 9.6%, so 75% of that. The other 25% includes MLPs that Marcia just mentioned.
Seth, is everybody looking where we are? I went to
Sorry.
slide 11 on your presentation.
This is actually a new presentation.
Yeah, it's a new presentation. It says quarter reports, fourth quarter.
Yes.
Is that where we are? Okay. And then I'm on slide 11. Is that where we're starting?
In my book, it's slide 4.
Okay.
125 in Village.
Thank you.
Yeah, 125, I think.
I'm on 49, all right.
Now, I'll jump to page 5, because 4 is way too much text to walk through. But the real assets portfolio, 75% of the portfolio is included here, or 79% of that real return portfolio is included in this presentation. Again, there are full fund summaries in the back of this report, detailed summaries on each one of the individual investments. This portfolio goes back to the inception date was 2011, so relatively new, especially when we're talking about real assets portfolio, which again is invested over a much longer time period than that. But this portfolio is defined as infrastructure, energy, timber, and agriculture, the primary property types here, or investment sector types. And we made one investment in 2011. Since that time, we've made 33 different fund commitments, 18 managers, so there's an overlap of managers. We're roughly committing about $2.4 billion in investments over the last 8 years. As you can infer from the 2011 inception, this portfolio has not been around very long, however, it's generating about 7.3% net IRR over that 8-year period. The funded allocation here is 6.9% of total plan. Again, like real estate, it jumps significantly due to the denominator effect. However, the portfolio is growing as new investments and new commitments are made. Performance is driven primarily by infrastructure and energy. Those two combined are really 80% of this portfolio, with the balance being timber and agriculture. And those target allocations are actually shown on slide 9 for your reference. The real assets portfolio is really primarily, again, income driven. These are hard assets. We're collecting payments for ownership of those assets. About 50% of the 5-year return was driven by income. Performance of the individual sectors varies. Energy is both the highest potential returns, but also the higher volatility of returns because of the correlations with the equity markets. Annual returns year over year in the energy portfolio range as high as 30% one year, and the most recent year was down negative 4%. So you see the volatility there. Over a long term, it's still performing well. Infrastructure being the other driver of performance has been more low double-digit returns, has been consistently at that level, 10 to 12% returns since its inception. And then both timber and agriculture are low returning sectors, low returning investments, and are planned and invested to be counter-cyclical to the rest of the portfolio. So during this rising tide, the bull market that we experienced, the performance has been impacted. Now, there's other reasons they've been impacted too. We're going to talk about RMS later in their presentation. But for those two portfolios, those are really much longer term, 10, 15, 20-year investments. We've been in those anywhere from 5 to 6 years. Most of those are held at cost today, so not really written down, but very limited value has been created in those portfolios. We can talk about them individually, but there's some existential effects of what's going on in the economy that is impacting the agriculture sector, that is impacting timber as well, and then the building sector. I will reserve to, if we stop on slide 5 for just a moment, we can give a similar slide in real estate, but this presentation here really focuses on the annual commitments made, the investment pacing that we call. Here, over the last 9 years, you see the commitments that I mentioned earlier. In the beginning, in the early years, we've made some larger commitments as we're building out the portfolio. But really, since 2016, 3 to 4 investments a year, $200 to $300 million is about what we anticipate committing on an annual basis. And you'll see that'll be consistent going forward as well. The last comment I'll make here in slide 14, 16, Townsend's page numbers, really look at the diversification and the allocation of the portfolio. So this is a global portfolio. 75% of the portfolio, though, is still located here in either the U.S. or developed or emerging Americas, with the balance being in developed Europe, developed Asia. We're not taking a lot of emerging geography exposure, but we are taking international exposure to this portfolio. That's part of the design. If you look at slide 16, again, similar to the real estate portfolio, we're well within the bounds. We're in compliance with our investment policy and following that very, very closely. And again, there's a lot of individual detail in this report about individual sectors, individual funds. Don't want to go into those too much, but I can talk all day if you want me to. But without going into anything further, I'll stop here and see if there's any questions.
Okay. Are there any questions? Comments? All right. Thank you very much.
Pleasure. Thank you.
Appreciate it. Okay, we are now on item 3. So let's go to 3A, and we'll have our investment committee report. Linda.
The investment committee met
and all members were present. We unanimously voted on the items that we will be voting on here and recommended them for approval by the council at large. That includes the annual investment plan, the BlackRock co-investment. And a co-investment is a little bit different than a straight investment in a fund. And I'm sure they'll discuss how co-investment differs somewhat. Also on the redemption, the change of the interim benchmark, the Townsend contract renewal, and Townsend is an award-winning consultant.
It's just not last year.
It's got your back.
Yes, yes. And I remember sending them a congratulatory note when I saw it in the Wall Street Journal. So we got an award winner there too. And after looking at an RFP that we had on the small cap, we decided on William Blair contract renewal, and Starla will be explaining why that at this point. But I do want to emphasize this annual investment plan was something I've been promising you was going to come, and here it is. And as you all probably noted as you read it, it's really the roadmap for the whole rest of the year. When you say, are we looking at any changes in our public equities? Look at the annual plan. Yeah, we got something going on there. What are we doing on the bond market? I mean, there's nothing to be earned there. Well, what are we doing about it? Our annual plan tells you what's coming. On all of our private assets, that's going to be real estate, private equity, and real return. Well, what are we looking for? What type of funds are you going to present? How many of them? How much money? It's all in the investment plan, that annual plan. So as we proceed the rest of the year, we know what's coming before us. We just don't know the names yet. So the annual investment plan is just a terrific thing. And not all large funds like us have these annual plans. This is something that we're showing great leadership in providing these and doing this. And so that annual plan is just terrific. And if anybody wants further discussion on those, I mean, the state investment office or members of the investment committee would be happy to go over any of those items. But it's really the crux of the rest of the year, so.
Thank you, Linda. All right, should we proceed with the 2020 plan?
Okay, thanks, Governor. Well,
Thank you, Linda. Thank you for your work on getting this done. We appreciate it.
Well, I'm just simply looking at what the state investment office does and monitoring it. They do one heck of a job. I'm very proud to be working with
Plenty of
them.
things to go around.
Yeah.
All right, Vince.
okay, if you go to page 186, that's the beginning of the plan. Now, I'll take some feedback, hopefully you'll privately on the introduction here, because this is the first year I've done this. This is the 8th year we've written the plan. The first year I did an introduction. Normally I put a summary there, but we try to keep it short anyway. And I felt like I was sort of taking two swings at the same pitch. So we took it out and tried to put an introduction in there to describe a little bit about why we do the plan, what it's for, how we have constructed it to make it a little bit easier for a wide range of people to read and understand. One thing I did not put in the introduction, and I think I will next year, we're working on just a study of the trends and things in broad public fund investing over this last cycle. Eventually we'll have a report for you, maybe August or September. But one of the trends in funds in this last decade or so has been to increase the stability and the consistency of their investment programs. This is a big item in creating some consistency in our program. So we write it every year. We give a broad macro view. We tell you what's going to happen in the individual asset classes, where we think the funds are going to go in terms of size and distribution and things. And we'll go through some of those things. But this is a big piece of the stability and consistency efforts that we make for our investment program. I was struck, one of the things we're looking into, or actually we're done looking at it, is what's the turnover of chief investment officers in large state plans. And actually, we go back to 2013, the data I have starts kind of falling apart before 2013. But since 2013, so that's 5.5 years, there's been 24 seats turned over at large public state-level plans, CIOs. 19 of those firms hired their deputy. So 19 out of 24 hired the deputy, most of them after a national search. They pulled the trigger on the deputy. 5 hired from outside, but 2 of those 5 hired someone who had worked there before in a senior capacity and gone to another fund or had gone to school or something. They hired him back as the chief investment officer of the fund. That tells me that funds want more consistency, want continuity to their staffs and continuity to their investment programs. This is how they're trying to make their returns. Half of the CEOs that left retired. Most of the rest went to the private sector. 2 or 3 went to the public sector, to either another fund or the federal government. Those 3 folks did. So one, I think consistency of investment programs is important, or has become important to funds, because this is not the way I recall it being in much of my career when CIO seats would turn over. A lot of times it was hired from outside, bringing fresh blood and these kind of things. But funds have really shifted to wanting more consistency and continuity in the programs. Part of that, I think, is complexity is up in portfolios, so we've got a lot more complex assets. Strategies take longer to implement now than they did, so when we all own stocks and bonds, that's pretty easy to manage. Once you start adding real estate, real return, and real assets, and hedge funds, and risk parity, and all these things funds are doing today, complexity goes up. And I think that's also a driver of why funds are looking for more consistency and stability within their funds. So this is a big part of ours. And if you flip over to, let's go just the next page. There's a graph there you probably can't read unless you really zoom it up in your materials. But what I tried to do here in the printed version anyway, the bottom thicker line, it's red. That's the cumulative rate of growth. And we mentioned this earlier. When we were speaking earlier. That's the cumulative rate of growth of the economy in real terms. That's X inflation, so after inflation. Or inflation is taken out. You can see it's up only about 25%. It's been the slowest growing economy in the last 6. In fact, when we look back, it's been the slowest growing since before the Great Depression. Now it's been long. You can see that line is, and that's just out through May. So once we hit July 1st, this will be the longest expansion that we've had, certainly compared to the last 6. But it's also been the weakest. That's been one of the defining characteristics of this cycle. We don't think that's going to change all that much in the forward 7 to 10 year period. If you flip the page, the next page, 188, that chart's a little easier to read. But the blue line is the labor force participation rate, or the labor force growth rate, and the red line is the annualized change in CPI. So you see those 2 things move pretty closely together. So the slower the workforce is growing, the slower CPI grows. We don't expect that picture to change for, we've got a good view of demographics, because they move very slowly. We don't expect that picture to change for another between 10 and 12 years before we start getting enough slope to it. So this next 7 to 10 year period that we've written about in the annual plan, if this relationship continues, and there's good reasons for it to do so, still kind of modest inflation, probably keeps interest rates down, probably keeps GDP growth down because labor force growth plus productivity growth are what drives GDP. Unless we get massive growth in productivity growth, this slow growth in the workforce is going to sort of keep GDP down, probably keep rates down, keep inflation down. You'll see later that's what we've got forecast for the next 7 to 10 year period that will be in. Just very quickly to page 189, there's a big table, you can read that one. On the left-hand side is what's happened in the last 10 years in terms of GDP inflation, stock and bond returns, 65-35 mix of stocks and bonds. We use that because that mix of stocks and bonds has roughly the same volatility as the average large public plan takes in their asset mix. So it's a fair comparison. to what public funds are, and then of course what the median public fund earned over the last 10 years historically. And then some ranges. There's a long run historical in the middle of the table, just for you to compare both left and right hand side to. The right hand side are our forecasts. You can see there's that slow real GDP growth somewhere between 1.5 and 2.5, on sort of rolling 3-year basis out to the 7 to 10. There's a range there beside it. Same thing with inflation. We think that'll pick up a little bit. We're sort of running 1.5 to 1.8 right now. We think that picks up at the 2.5% range on a go-forward basis. That only puts nominal GDP at 3 3/4 to 5. Now, corporations really need about 5% nominal to do well on the top line and keep their revenues growing. Now, profits can grow even if revenues are slow, and we've seen that. So we've seen margins expand, and corporate profit plus share buybacks, corporate profits have grown a lot faster than the revenue set. At some point, those two things have to come a little closer together. And corporations need about 5% nominal to do well in terms of revenue growth. So we see a slow revenue environment for corporations today. Of course, investments related to corporations are by far the biggest chunk of our portfolio, of our investments. So that means, I think, stocks are around 5.5% with, a reasonable range around that. Compound over the next 7 to 10 years, bonds maybe at 3% with a range around those. 65-35 mix only gets us about 465 out of that mix. I think the median public fund then earns 550 over the next 7 to 10 years. Now, we have a 7% return target. We've had some discussion about that. That 7% return target is for a much longer period of time, 20, 30 years. We do think stocks and bonds and general investments do better over the next 20, 30 years than they will in the next 10. And we have consistently been above median with the public fund. So we're still comfortable. I don't think we're going to come back with a suggestion to cut your target rate of return. Although if you want to have a discussion, we certainly can plan that, talk about some of the dynamics that are going on there. So sort of slow economy, rates stay in control, and inflation seems like it should stay in control, although that's probably the call I would be most nervous about, getting all the QE and all the money that's just hit the economy. It's all been soaked up into the financial markets and can get destroyed that way when markets fall apart instead of having to push consumer price inflation. But you saw the chart earlier, that's a pretty important one, and just don't expect that it will grow that fast. So that's what we're facing, I think, over the next 7 to 10 years. We've been positioning the portfolio for this quite some time. I think we're in a pretty good spot. 40% public traded equity is well below the median of public funds today, so we're taking a lot less risk in those volatile markets. We've shortened durations up in the bond portfolio, so we're not exposed if interest rates do rise. There's not so far to fall, so the opportunity cost is very great to have short duration. But if we do somehow get inflation in the system and interest rates pop up on the long run, we're quite well protected against that. And our portfolio flows cash like crazy. We're very much investments that produce high levels of income relative to the capital gains portion of the total rate of return that we expect. All that money in the downturn can get deployed in cheaper assets. We're working on a presentation for you, next few months to talk a little bit about early cycle. So once we get into recession, usually the stock market bottoms in about the middle of the recession, although we don't find out we're in recession until about a year after it's begun. But stock market usually bottoms somewhere near the middle of the recession, starts popping back out before the recession's over. By the time we get to early cycle, there's a lot of things that typically happen in there that we can make some shifts in the portfolio to take advantage of. So we'll try to get you a report in the next few months. We'll talk a little bit about recession. That's just awful, so we won't talk about too much. But for the early portion of the cycle, we want to focus on how we might want to shift the portfolio, some things we might want to do to advance ourselves when that comes. The rest of this really is the asset class. Well, let's see. Let's first flip to page 191 in your book. That's the three primary strategies. You all are just, know these cold. We talk about them a lot. We've reduced that public traded equity. We were just talking about 40%. That's fairly low relative to a peer group. We've raised liquidity and structured our fixed income portfolio to weather these type of markets and to be something we really want to have when the markets do turn over. And then, of course, generating income as we talked about. The next page just very quickly shows where we think what we think the value of the land grant permanent fund could be over the next 10 years. The middle number is 23 billion. We're at 17, almost 18 today. 18 at the end of this year, I guess. That's where we're projected. So some growth in the land grant fund, and then there's some ranges around what it could be. The table below that shows what distributions will be or could be from land grant itself. So about year 6, we'll cross $1 billion. If all goes well for us, if it goes very well for us, we'll get $1 billion between year 3 and 4 toward that table. The next page is the same stats on severance tax. Not such a good picture as land grant. For this fund, just very, very slow growth, and both in asset size and distribution are our expectations. We are going to upgrade, I think, the model on severance tax, given some of the legislation that's happened. We think this picture will improve relative to the model that's calculated these things. But the rest of the presentation is really on asset class plans. So I've got all 4 asset class directors here. I can talk anything you want to talk on macro, portfolio construction, and my ECDs can take you through any of the asset class plans that you'd like to hear about.
Thank you, Vince. What is the pleasure of committee members? Additional information?
I
Linda?
think there's benefit for us having presentations from the asset class directors saying what they think is happening over the next year, what direction we'll be taking. So I think it would be beneficial.
Any objections? I agree. All right. We would like that to occur. Yes, sir.
I can start off.
All right, you can start off. You want to come to the front so we can just see you easier?
So in terms of real estate, very much like what Bruce was talking about is, we've had some really extraordinary returns in real estate, even in our core funds. They've performed very well. We had some years there where core funds were generating 12 and 13% returns. That is over. We are getting much more into the 4.5%, 5%, 5.5%, 6% range on most of our core funds, which are our conservative funds. And it kind of remains to be seen what's going to happen with our value-added and opportunistic funds. But we always expect a return premium from those. But entering into a much more difficult environment now, as you try to find deals, you don't have the wind in your back with these massive increases in annual rental rates and things like that. So our opportunistic value-add non-core managers are having to work a lot harder to generate the returns that we're expecting out of that portfolio. On the real asset side, I think as Seth said earlier, our infrastructure assets just chug along. They're doing exactly what they're supposed to do. They have not really been terribly impacted by this decline, this general decline in returns. So we're happy about that. They're really lifting our real asset portfolio. Energy is the second largest part of that portfolio, and it's highly volatile. We've had years, as Seth said, that have produced great returns for us, and other years that have been not so great. This year, 2018 was not so great, but we expect that will bounce back and recover at some point. So timber and ag are conservative strategies. They're counter-cyclical. They have an important role in our portfolio. We don't expect much in the way of return from them. They are lower returning asset classes, but they are good anchors to our portfolio. Now we're going to do some adjusting within that portfolio where we can, and we're going to talk about that in a little bit. But that's sort of the lay of the land generally. I can go into more detail if anybody wants.
Linda?
Could you give us the pacing schedules?
Yeah, so we use, Townsend has historically prepared our pacing models, which is the rate at which we make commitments into real estate, real asset space. And we've recently done an internal model that we're actually going to use going forward. The numbers are quite consistent between the two models, but basically you should expect to see something on the order of $300 million a year, $250, $300 million a year of new commitments in the real asset space, and about the same in real estate. And we typically like to make commitments in, we don't like to, as someone said to me the other day, what number do you not get out of bed for? Well, we try not to make commitments in the $50 million range, except under very special circumstances. Evan gets mad at me because they take a lot of time to get them documented and so.
We like it when Evan's cranky.
Well, then you're a very happy person. So our sweet spot is really $100 million, and if it's a newer manager or if it's a riskier strategy, probably $75 million. So we're only going to make 3 or 4 commitments in real estate and maybe 3 or 4 commitments in real assets in any given year.
Thank you.
Good.
Any questions, comments? All right, thank you very much. All is next.
Now, I'm going to stay here
You're gonna
because
stay here?
I'm up shortly after this.
So for fixed income, as Vince mentioned, we're generally taking a strategy of moving money from what we call core fixed income into the non-core fixed income portfolio. You can think of core as, and this is generally true, not entirely true, but think of core as government securities and investment grade bonds. And you can think of non-core as private credit. And private credit is loans that are not publicly traded and they're privately negotiated. They usually have a little more risk on the credit side, riskier companies. But the other risk that we look at in fixed income is interest rate risk. And even though the non-core is thought of as more risky in terms of credit, it's actually less risky generally in terms of the interest rate risk. So if interest rates rise, many of the private credit loans are floating rate in nature, so those loans would move up with interest rates. So generally our strategy lately is to, and this fits in with the late cycle nature that Vince has talked a lot about, we're looking for resilient strategies that can withstand a downturn, and we're also looking at strategies that we can pivot into to take advantage of a downturn. So, for example, the funds that we brought to you lately are infrastructure debt funds, which is generally seen as less economically sensitive, and we brought, that's the GIP fund. And we also brought a PIMCO PIF fund, which has the ability to invest in less risky securities and then pivot into more risky securities in the downturn. And I'm happy to answer any questions related to the fixed income strategy.
Do we have any questions or comments from committee members? All right, thank you. Musical chairs. Just be careful with those chairs. These chairs are awful.
Okay, so the public equity portfolio, Clayton and I will be focusing on structured studies in U.S. and non-U.S. Portfolios. In the international portfolio, the analysis will focus on resolving the issue of investing in India. And the other changes are expected to be sort of at the margins, like tweaks in manager allocations and index updates. In the U.S. portfolio, we expect to stay the course in the near term, no changes. And then put together before the council a structure
for a portfolio with more juice, higher beta, and it takes into account difficulty of generating excess return in the U.S. market. So that's the plan for the next year, and it's aggressive. So FactSet and Clayton really make this possible.
All right, any questions, comments? All right, thank you.
Private equity updates for the next year. Chris and I are staff of private equity. And for the national program, as you saw in the materials, the strategies mainly focus on buyout, growth, special situations, and venture capital managers. The special situations and the venture capital we de-emphasized a little bit in the national program, primarily because in special situations we've got some overlap with some of Bart's distressed strategies. And venture capital, we feel like we have a lot of exposure in the New Mexico program. So in terms of the national program, as we look at sort of the risks going forward that Vince has outlined, for instance, in public equity. In private equity, we do stay concerned about the multiples that these companies are trading at on that line. And we're also watching debt markets because leverage is a very important part of these transactions. So we're trying to keep an eye on that as we look forward at the managers that we're bringing. First of all, there's been an adjustment on the pacing model. We've moved the commitment pace down to about $350 million a year from $550. So a slower pace in recognition of the fact that our funding period will grow a little bit slower given RBK and strategy groups assumptions going forward for lower growth. And the managers that we're looking at, we're focusing on downside protection. What do we mean by that? We're looking at things like historical loss ratios, how they performed in, for instance, the great financial crisis, see how their companies have performed, how cyclical or non-cyclical they are, and basically how well they grow after that recession is over. So we're still looking at the best opportunities that we can, but we're being as selective as possible. And actually, for the last couple of years, we haven't hit that previous pacing target because we continue to try to be selective. That's in the national program. In the New Mexico program, we are still continuing to look at both the co-investment funds and the regional funds and trying to keep up that pace as aggressively as possible. We have a new consultant with Mercer who does our national program. And together with staff, we are evaluating everything and we should be bringing some commitments very, very soon. Anybody have any questions about that?
Thank you for asking that. Anyone, comments? Okay, thank you. Are we good?
That's all.
That's everyone? All right. Linda, seeing that there are no, any overall questions about the strategic plan? Yes, Secretary?
So how does this annual investment plan, how does it relate to the asset allocation plan that's done annually? And then I'm not sure if we do tactical and quarterly adjustments, but is this one and the same with the asset allocation plan that's done by our advisor? Is it just incorporated into this?
We do asset studies. We try to do asset studies once every 3 years. We can do them anytime we all want, but typically we do it every 3 years for each of the funds. We don't do any tactical positioning normally. In really volatile markets, we may take some tactical positions just because it's so volatile, it's easier to take advantage. But kind of run rate markets, we don't. But I think I wanted to thank Linda for bringing the asset class directors up, because what you saw is a very top-down investment program where we developed that strategy as you were talking about, set the asset allocation based upon that, and then push 2 or 3 or 4, broad strategies down into the portfolio and the asset class directors execute. A lot of your peers couldn't have this conversation. Their asset class directors and their teams are picking stocks and bonds and doing things from the bottom up. So this spirit is quite top down, macro view, and strategy building, asset allocation, those things. That's how you make your money. You organize yourself.
Thank you very much.
Depends when you're having your rebalance, and that's not being tactical, but when you're rebalancing and making decisions within those ranges.
Yeah, there's two types of activity we take. One is just generating the cash to fund these, make distributions and things. And then at various times, markets are performing in various ways. So if you get stocks really running, the bonds just sitting still, and then your stock portfolio gets too big relative to your bond portfolio. Sell stocks and bonds.
Thank you, Secretary. Any other comments, questions? All right. Cindy, we're ready for a motion.
Based on the recommendations of the Council Investment Committee, SIC staff, and the General Fiduciary Oversight of RDK, I move that the State Investment Council approve the 2020 annual investment plans as memorialized and discussed by the Council in today's meeting.
So I have a second. I have a second by Lynn. Do we have any comments, questions, concerns, additions? Hearing none. All those in favor say aye. Aye. Any opposed?
Aye.
An aye. All right. Duly recorded. Do we have any objections? Anyone abstain? Motion carries. All right, thank you, members. We are now on item 3C, and it is the BlackRock co-investment.
Sure.
Thank you. Well, this may be the first time that the council, as currently proposed, has heard about a co-invest. So let me just take 1 minute and talk about that. We do most of our investing in, at least in the private asset classes, we do our investing through open and closed-end funds. There's been a lot of pushback towards the general partners for the fee structures, which can create quite a spread between the gross returns and the net returns. One of the things they're doing to sort of maintain their rack rate is to offer co-invest to their limited partners. And it's usually on some ratio. If you commit 100 million, you can have 33 million co-invest. If you commit 100 million, you can have $50 million of co-invest or something like that. There's usually a cap. So the advantage for us, in most cases, is there's either a discounted fee structure or no fee. So in this case, we're talking about co-invest, no fee, no carry. So we'll pay the regular fees, the incentive fees, and the basic asset management fees on the $100 million commitment, and on the $50 million commitment, there's no fee, no carry. There are other managers that are going to have a discounted fee and carry on the co-invest component. So we made a commitment to a manager that we've been with for a couple of rounds, BlackRock Global Energy Power Infrastructure Fund. We made a commitment of $100 million in the fourth quarter of 2018. And at the time, we talked about making a co-invest, but we didn't ask the committee's approval for that action. So now we're coming back and recommending that we make this co-invest commitment to BlackRock. So as I said, this is a closed-end commingled fund. It invests in core plus and value-added strategies in the energy and infrastructure asset space, predominantly US and Latin America, and we're targeting net returns of 11 to 12%. Co-invest, we might even get higher than that because we don't have the drag of the fees. The predecessor fund, which is BlackRock Global Energy Power Infrastructure Fund 2, has generated a net IRR of 34.3% as of Q1 2019. Don't get the impression that this fund is about swinging for the fences, though. It's much more conservative than that return would indicate. They had one investment that produced a phenomenal return, almost a 4 times multiple on money. So the fund without that would be producing about a 15% IRR. They did some co-investments in Fund 2. We didn't participate then, but we are recommending to do so now. All co-investments are made alongside the main funds. So we get the same level of due diligence, the same operational skill set is applied to the management of these assets. We just go along for the ride. They've allowed us, BlackRock has allowed us to limit our exposure to any one investment to $10 million. So out of the $50 million of commitment, we'll end up in likely 5 or more co-investments. So the advantage of just to put some numbers around this, often we see a spread between gross and net returns of 400 basis points. And if you think about that, 400 basis points on $50 million is $2 million a year. So that's the potential, sort of the upside potential of what our savings would be here by going to the co-invest program. But there's risk with co-invest. Co-invest, it means that in addition to the investment we're making in any given deal, as an LP in the main fund, we're sort of doubling down, and we may make a like-sized or even larger commitment into the co-invest fund. So if that one asset underperforms, we end up with an underperforming investment. But the way I look at this, as we grow our co-investment strategy, we'll have really a highly diversified portfolio of co-investments out there, and no underperformance of one investment is going to drag down the returns. So that's really it in a nutshell. I'm happy to turn it over to Seth to discuss further.
Sure. I didn't have any other additional comments. I guess the only other comment I would make is BlackRock's really offering 2 different co-investment structures here. One where discretion sits at the investor level, at the SIC level, and the other where BlackRock holds the discretion. So because of the structure, because of the timing of making these commitments and the monthly meetings that we have here for approvals, it's more prudent for us to make the commitment to the discretionary portfolio, the discretionary vehicle, where BlackRock ultimately makes those investment decisions. You're not coming back to you every month with a potential opportunity, or it could be a week turnaround, and we just don't have time to meet, gather, and approve those investments. So this is discretion of BlackRock, and again, no fee on that, even with that discretion.
And that's exactly the situation we're in when we're an LP in the main fund. They have full discretion over all their investments, so there's really no difference.
And then maybe the one last comment is that the BlackRock has enabled us to set some parameters, as Paul said, about what those potential investments look like. So you're not willy-nilly into any possible investment. You do have parameters that the SIC has set with them to say, okay, yes, this one qualifies for what we want to do for co-investment, or whereas this one does not.
Thank you. Members, any questions from the members?
I just want to, for those who aren't as familiar with co-invest, they've said it, but to be even more emphasis, say that the fund invests in 18 investments. The co-invest fund might only invest in 4 of those. So the co-invest fund is not just a mini version of the main fund. And that's why if we're invested in these 18 in the fund, but now we've got 4 that we're adding more money to, that's where he was explaining the potential risk of there may be winners or losers that we've kind of doubled on, we don't know. Yeah.
And maybe to provide a little clarity, why does the manager do that? Why would they say, okay, well, we've got a potential investment that they want to make. So
why don't they just do it?
And then, why don't they just put it all into the fund? Well, what ends up happening is that in many cases, the fund has parameters that it has to abide by as well. No more than X amount in a particular investment or X amount in a particular geography, things of that nature. And so they'll say, okay, let's say there is a caveat of no more than 10% in a particular investment. And this one particular investment would have put them over that 12% or 15%. So what they'll do is take the 10%, put it into the fund, and then the remaining 5% we put it in a co-investment vehicle. So that's part of the rationale. And then furthermore, just the manager may say for portfolio diversification, et cetera, we don't want all the exposure sitting in the fund. We may have too much of that particular investment or type of investment in the fund, and so they'll put it over into the investment vehicle as well.
But of course, we've already approved the fund, so we already have addressed that we like this fund. The investment committee has kind of struggled and haven't come to a conclusion yet, but I think one is probably due, whether we should give the state investment office authority to just do co-investments or authority to do co-investments to a certain amount, or approve them at the time of we approve the fund or something, because many of these co-investments have a short fuse, and our meetings prevent us from using that opportunity. So we will be kind of discussing this further, and I'm sure we'll come up with a recommendation to the council as a whole on authority for co-investments.
And this is a practice that many of your peers are regularly investing in, and you've gotten to a point now that both your real estate and your real assets portfolios are broadly diversified, and this is where you can gain some additional tactical exposure in many of the investments that you're making. So it's a very prudent and successful manner that many of your peers have been doing for years at this point.
Any other questions from the panelists? Senator Lawson?
We have a parameter on there of no North American midstream transactions. I'm wondering what the basis for that is.
So as you heard previously mentioned with the MLP portfolio, MLP is all U.S. midstream. And so we've already got a large exposure to U.S. midstream through that portfolio. It's nearly $400 million. So we'd rather just leave that where it is and avoid further exposure there. We've got plenty already. And the other thing is that we get a lot of that exposure through other energy funds and other infrastructure funds are buying pipelines and processing facilities. So we already get that, as an LP in several main funds of our infrastructure and energy managers.
Now, with regard to Linda's thought about maybe just giving staff the option or approving it, maybe when we approve the underwriting, the underwriting investment, it seems to me that might goof up the pacing model to some extent, or maybe there's some, are there minimums? For instance, in this case, we have a $100 million investment and co-investment's going to be 50. Is there a minimum opportunity there that if we're going to go that direction, we base it on some sort of maybe a percentage authorization that wouldn't goof up, the overall pacing model that we're trying to get to, and also wouldn't dominate, because a 50% exposure is a whole lot different than a lower amount. So I just wondered what those look like.
So, so on your point about pacing, one of the reasons we didn't come to the investment committees with this co-invest fund was that we had really fully committed our 2018 and a lot of our 2019 capital. So we didn't really have the headroom to be making additional co-invest commitments. So we talked about it, but we didn't really have the capital to do it. Now we're actually, next item, we're gonna liquidate, redeem out of one fund. That'll give us a little bit of extra capital to move over to that. That's sort of how we're thinking about it. The timing won't align for sure, but that's sort of how we're thinking about it. So the pacing really does play into it very much.
And we can also take that into consideration when we're doing the annual pacing models that, okay, well, this commitment will be 100 into the fund and 50 into the co-investment, and we can set different parameters as to how that capital gets drawn down and ultimately how it comes back. So we will take that into consideration as we make those investments, and then you all can approve based on the pacing model.
Are there minimum co-investment amounts?
It depends, to be frank, and so we probably, similar to what Paul's comment before, really wouldn't want to make a commitment less than $50 million. And no matter what, the staff is limited here, and so as you're making commitments, the same amount of resource intensity is going into those as you would for 100 or 150 million. So that's probably around the sweet spot for the co-investment vehicles. Maybe a little bit more wiggle room because it's a little bit more tactical, but depending upon the opportunity.
Okay. Thank you.
Thank you, Senator. Anybody else? Mr. Treasurer?
Thank you, Governor. Paul, thank you for waking me up when you talked about the gross versus the net and 400 basis points. It really caught my attention. So I guess what goes to BlackRock, what goes to the first resort team in the management fees that we have here?
Oh, jeez. You call that set?
Just,
And then could you also talk a little bit about the independence of the first, the independence of that first?
Of the old first reserve team that's now part of BlackRock.
Is there any, there is independence?
Yes, there is independence. Now, I believe the general partner or the managing director of what's left, the private equity side of First Reserve, is on the investment committee for this fund. He was on the last fund, I can't recall now he's on this one, but that was the one carryover. And then there was obviously carried interest in Fund 2, but I don't know whether that continues into Fund 3.
they retained the first reserve team almost in its entirety, I think we did in its entirety. And they are now part of the organization. And that team, BlackRock has, they utilize BlackRock more as a back office support, marketing support, as well as some members on their investment committee, so they do have institutional knowledge of the asset classes, but it's driven by Mark Florian, who is here presenting this investment in the fall, as well as his team, to really what's driving the performance, what's driving the portfolio construction. And that's still the first reserve team. It was more of a lift out than it was sort of acquisition.
In terms of carried interest, I can't speak to the management fee, but carried interest, 50% of the fund team, 50% is BlackRock. And then the fund team allocates, managing directors get a certain pool of that, and the analysts and the more junior employees get a share as well.
Certainly. Anybody else? All right, seeing no more questions or comments, Linda, we're ready for a motion.
Based on the recommendation of the Council Investment Committee, Real Estate Advisor Townsend Group, and SIC staff, I move that the SIC approve an additional commitment of up to $50 million to BlackRock Global Energy and Power Infrastructure 3 co-investment, subject to and contingent upon New Mexico state law, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second. Terrific, thank you, Lynn, for seconding. Any more discussion, comments? All right, seeing none, all those in favor say aye. Aye. Any opposed?
Aye.
An aye. Any abstain? The motion carries. Thank you very much. Thank you. All right, we are now on item 3D, and it's the RMS redemption. So we've got Chapman and Townsend right where they ought to be.
Right where they ought to be. So first of all, I want to say that RMS is a good manager. We respect the team. We think they're very knowledgeable and effective. This strategy ended up being invested in the Southeast market, and the Southeast timber markets have been really hammered by really lack of housing starts. Remember when we went into the Great Recession, housing starts were around 2 million units, more than 2 million units a year. Now, after the recovery, there are 1.3 million new starts per year. So housing activity is way, way down from where it had been historically. And meanwhile, the timber keeps growing on the stump. So the inventory is building, and I think the inventory is projected to sort of max out this year or next year, but the inventory keeps on growing. So it's really been difficult for lumber prices. So as a consequence, returns in the lumber industry and the timber industry in general have been weak, not just with this manager, but with all our managers. So, so fundraising has been difficult in the timber space. And RMS was really originally conceived to have this one seed asset, this Red Mountain Timber Holding, which is, as I said, it's all in the southeastern United States. It was conceived as being a more diversified fund, but fundraising got in the way. They didn't have capital to buy new assets. So here we are, we have a fund that's unexpectedly under-diversified. And so we would just like to move that away from that timber allocation, downsize our investment or right-size our investment to $75 million from the current commitment level of $125 million. I don't think there's a lot more to it than that, but I'm happy to, Zach, if you have any other comments or.
The only other comment I made is when we made this commitment, this was 2016, our timberland portfolio was still in its infancy. we were making this commitment alongside other commitments that we had made basically a year or two before then. Those investments were much more higher returning, higher risk investments. There's one of them in Brazil. One of them is called a pre-merchantable strategy, which is basically a development strategy. It's very, very smaller, younger trees that cannot be cut and sold. So this was a way to further diversify the portfolio into a established track of timberlands, and really make that portfolio a little downside the risk profile of the portfolio. So that was why the original commitment was made. It was outsized at $125 million. We are right sizing the commitment today. This is an open-ended fund. There was a 3-year lockup that recently expired, which was why we're here. That expired earlier this year.
Thank you. Seth, anything else? Oh, Scott?
Governor, do we ever contemplate liquidating the whole entire thing instead of switching? I don't read much positive about that part of the country with respect to timber. If that extends further, we have the ability to get out, why not take a larger step, so to speak?
Well, we can do that, and we may do that, but we're not trying to eliminate our entire timber exposure, number one. Number two is, unlike a lot of funds that deal with open-ended funds typically have a lot of capital flowing in, and then that gives them capital to liquidate redemptions. But the other big source of capital to address redemptions is the constant churn of assets in the portfolio. So they're selling assets all the time. So they've got these two buckets that they can draw from typically. In this case, they've got an asset that's very complex, and really you can't sell off parcels today of this overall Red Mountain timber. Our fund, the Evergreen Fund, has a 24.3% interest in this overall timber holding. So there's some complexities to getting out of it, and we're really looking at how quickly they can raise money from new investors, which is really going to govern how quickly we get capital back here. So I don't think it matters whether we put 50 million or 125 million in here. I think it's really going to be, we're going to get liquidated at the pace of these, how quickly they can raise money, which has not been fast. So this will take a while to liquidate. I think that's.
Thank you.
I think that's it.
Scott, any follow-up to that, anyone? Anything else?
The other important thing I wanted to say is that we have a LPAC advisory seat, and we lose that seat if we go below $75 million of commitment. This is a very complicated resolution as we go through this whole Red Mountain Timber and the Evergreen Fund liquidation, and we want to have a seat at the table to make sure that that's happening appropriately. But.
Yes, Linda? You ready for a motion? I think we might be. Please proceed.
I want to commend them. This is a great example of why we're always looking at not only what we're going to buy tomorrow, but what we bought yesterday, and see if it's still working. So I think this is great.
I need that to help me with my personal purchases. I thought it's still working. Not one thing.
Based on the recommendation of the Council Investment Committee, Real Return Advisor Townsend Group, and SIC staff, I move that the SIC approve a $50 million redemption from RMS Evergreen U.S. Forest Land Fund LP as memorialized, reviewed, and discussed today by the Council.
Second. Got a second by Lynn Hoffman. Thank you. Any other discussion, questions, comments? Seeing none, all those in favor say aye.
Aye.
Aye. Any opposed? Aye. Any abstain? The motion carries. Thank you.
Thank you.
All right. Okay, we are now on the interim benchmark, 3E.
That would be page 250, Governor.
Thank you. That's how.
While you get there, I have to tell you that I've worked pretty hard to get that last one past my wickets. You did. I just love this asset class. Look, 70% of your returns, Steve always gives me a hard time. 70% of your returns come just because the daggone tree grows. So the rain falls, the sun shines, tree grows, you get 70% return that way. And those things, they breathe in carbon dioxide and the ocean, and they breathe out oxygen, and it's just a wonderful investment. except for this one. At least financially. I think we've got all those other very quickly on this, if you turn to page 250, it's the very first table here. This is information about the land grant permanent fund. You can see your current targets on the left-hand side, at least where the numbers start. Where you were on 4/30/2019, what I'm recommending you go to, what the change was, and where your long-term target is. You can see I almost have you there. We're still having a little issue with core, fixed income, and non-core. That's why those two will remain, core will remain overweight, non-core will remain underweight relative to your long-term. Not quite there on real return. We had a little bit, it's been slow getting that money out to work. So we still need a underweight there relative to your long-term. Otherwise, we're there. I'm really happy about that, because we moved that stick like 3 times. And we've been having to try to catch up to it over the years, so we're almost there. This, I think, is a very strong asset allocation for the point in the cycle that we're at. So I mentioned earlier, 40% public traded equity is well below median in terms of what other public funds are doing. I've seen some funds with 30, 25, but the fund has 25 as levered. They use about 10 or 15% leverage. The funds that are at 30 have very big non-core fixed income, private equity, so a lot more of the private markets in lieu of public markets. So I think we've got a very good mix. That's the long-term mix, a very good mix, particularly for this portion of the cycle. Will probably come with some recommendation change when we do get into the next stock market sell-off, supposing it's big enough to want to move back to equities. But we'll work closely with RBK on forward-looking assumptions and sort of bring you a good, solid underpinning for doing anything like that. But for now, I think you're right down the middle and are going to continue to produce good returns, at least relative to peers on a go-forward basis. Severance tax is on the second page, very much the same story. Just a little overweight in core, fixed income, a little underweight in non-core. Hopefully we'll get that rectified. I don't know, Bart, were we talking 3 years? We thought 2 to 3 years.
Certainly 3 years.
Make that happen. We'll make it happen faster if the risk assets sell off, because that core portfolio is going to go into the market into risk assets when that happens. So if we get a sell-off sooner in 2 or 3 years, we'll have you closer. But we're right on target for both real estate and private equity, and still be a small underweight in real return until we get that portfolio a little bit bigger. That's the long and short of it. I've been coming to you every 9 months to a year to change it. I would anticipate X, a big rollover in stocks before then, and another 9 to 12 months, hopefully, to get you all those on target.
All right, thank you. Vince, any questions? All right, comments? Thank you very much. Are you ready, Wanda? Okay.
Based on the recommendations of the Council Investment Committee, General Consultant RBK, and SIC staff, I move that the SIC approve changes to the interim policy benchmark of the Land Grant Permanent Fund and the Severance Tax Permanent Fund as memorialized, reviewed, and discussed by the Council today.
Second. We have a second by Member Lynn Hoffman. Any other discussion? Hearing none, all those in favor say aye. Aye.
Aye.
I'm getting better at my timing. All those opposed? Any abstain? Seeing none, the motion carries. Thank you. All right, we are now on 3F. It's the Townsend contract renewal. We've got Paul Chapman back up and Vince.
Well, Madam Chair,
Yeah.
just for clarification, because of the timing, what I heard Peter vote no on those two, but what you're just saying, you think he voted yes.
I did.
On both of
Yes.
those, it was just delayed. So I just want to make sure we got it recorded of that.
Ah, I thought he was just a delay.
I thought it was, he was responding to your call for no.
Let's ask him. Harold?
I voted yes on everything.
Okay,
I thought so.
I just heard. Okay, that's good.
Yeah. Thank you
Because
for.
when we get to the minutes,
No, there's no,
That's
there's
good.
not a problem clarifying and making sure we get it right for the minutes, so, but I don't mind being right over the senator anytime. All right, thank you. Thank you, Senator, for making sure we get it right. I'm grateful. All right, Paul.
Okay.
The last item that I have today is that the renewal of the Townsend Consulting contract. This is a 4-year renewal. The financial terms are disclosed in the board's materials. And as you heard from Seth earlier, Townsend has been providing real estate and real return consulting services to us since 2011. We've gone through, I guess, 2 renewals of their contract. Staff is extremely satisfied with their performance. Their reporting, their accessibility. Obviously, we're very happy with the returns, both in the real asset and real estate space. So we are quite content to keep Townsend as our consultant. You guys have obviously met Jack and Seth. Some of you who have been on the council for a long time, know that we have 2 quality consultants attached to their bios in the board book material. So you won't find any surprises there. I think we're very well represented. Seth alluded to, I think he made the comment as it relates to real assets, but they've done $2.7 billion of total commitments to 36 funds there. On real estate, $1.9 billion of new real estate commitments and 29 strategies since 2011. Each of these commitments, requires a lot of time and work on behalf of the Townsend Group. So we're not just getting the resources of Jack and Seth, but there's a big, deep organization that provides a lot of work. Everything that's brought here is approved by a robust investment committee. They've got a very strong research group that we rely on, a lot of back of the house operations. So bottom line, we're very happy with their services. We recommend a 4-year renewal of the contract.
Thank you. Are there any questions, comments about the contract renewal?
The matter still remains that they did not win any major awards.
So verify that.
I mean, we've got,
I'll talk to them.
we do, because Linda, while we appreciate the recognition, we need it again. It has to be a
What have you done
consistent
for us,
award.
Lee?
Yes.
Can't we just give them a soft little?
Actually, wasn't
What
Seth
happens?
recognized as one of the 40 under 40 in the yeah,
700.
yeah.
And we continue our downward trend. All right, Linda, would you please help us make a motion?
Based upon the recommendation of the Council Investment Committee and SIC staff, I move that the SIC approve a 4-year contract renewal with Townsend Consulting LLC to serve as the SIC's real estate and real return investment consultant under terms and conditions detailed in today's meeting materials as reviewed and discussed today by the council.
We have a second, Mr. Treasurer, we have a comment.
I have a question, Chair.
Okay,
We'll second it for discussion.
thank you very much, Senator.
In your report, Linda, you put a 3-year contract renewal in.
Yeah, staff engineer
And it was a
in,
4-year.
yes, 4 years.
Thank you
So
for
when I
bringing
say
that.
staff, I mean me.
So it was noticed correctly at 4 years and.
Today it was.
And as with all other contracts, it does have a 30-day notice.
Making sure that, again, we're correct for the record. Thank you, Mr. Treasurer. We're okay? All right. Thank you for finding that. Yes, sir.
I just wanted to find out, I didn't hear that there was a contingency that they find a buyer for the train yet. But they'll keep looking into that.
We've been trying to plug that train to everyone who comes through here.
I think that.
Infrastructure.
We have a lot of work to do. Thank you very much. Thank you, Senator. All right. All those, any more discussion, comments, concerns? All those in favor of the motion, say aye. Aye.
Yes.
Any opposed? Any abstains or abstentions? Seeing none, the motion carries. Thank you very much. Congratulations, Mr. Townsend. We are now on 3G. It is the William Blair contract renewal.
So we're recommending all-year contract renewal for emerging market manager William Blair for 3 reasons. We weren't able through the RFP process to identify a manager that satisfactorily resolved the issue of investment in India. Second, Bloomberg proposed an alternative that mitigates some of the risk in your strategy for investing in India, which, looks good to us. And then with FactSet staff has better tools to determine structure for the international equity portfolio, which would include a long-term emerging market manager, but this may take up to a year to do so. So we're recommending a one-year contract.
All right, 1 year contract renewal, correct enough. I'm looking to the treasurer now.
Oh, I just have a question.
Okay, let's do both then, Mr. Treasurer.
On FactSet, how is that implementation coming?
It's coming, we're working on data, getting data uploaded and having quality data and historical data is really the key to good analysis. I give it 60 days, we hope to have it up. 90, we hope it will be longer. The implementation takes a while. Then after that, we work on the analysis. But I think it's going well. It just takes time and always gets slower than we hope.
So I don't know if I understand that answer. So there haven't been any major issues that you're concerned about.
No,
Right?
definitely
It has not been as easy and it's taking therefore a bit longer.
No, it's not
Okay.
taking longer. It's going well. They were out here.
So they're on
today.
schedule. I just couldn't tell what your answer
I'm
was.
sorry. Okay, yeah, they're very responsive. It's going as expected. Just, it does, take time, but it's, it's going well. So, sorry about that.
Karen, if I could follow up.
Yeah, please.
The reason why I asked was because in your first comments about William Blair back on page 180 something, 184, I guess it was. It was your fact check, I guess, that you were really counting on for this next year. At least that's the impression that I had. Your presentation today didn't change my mind. I don't think we want him. I'm glad you're only asking for a 1 year extension. But I appreciate your comments. Thank you, Kevin.
Thank you, Mr. Treasurer. Yes, Senator Crossman.
Yeah, Madam Chair, Starla, can you refresh me on the Indian market issue?
Yeah, the couple of big ones are that to register in India, it requires personal identification from Stephen Dents. They also, India Exchange clubs, like investors in the United States. So from their perspective, our investments, Alaska Permanent Fund investments, are from one entity. So they do what's called clubbing. They haven't been speak to that all day long. Those are two big ones. There's not a lot of ADRs available for the India securities. So there's ETFs. There's, when the recovery will fund the accounting trade-offs with that option. So it's balancing investments, legal, accounting. It's a growing market. I mean, the allocation index for India has grown significantly and is expected to continue to grow. So if you don't address the issue, you're really leaving an opportunity on the table.
Evan, did you want to add anything to that?
Do you need more, or I can give you 30 seconds, or?
Go for it.
Okay, so you look at your benchmark when you do international investing, by a benchmark, you say, how am I doing? India is a big part of that benchmark. And the question is, how do we as an entity get exposure to India? The Indian SEC, for lack of a better word, is called SEBI. That's who they use to regulate companies, to regulate investors. They are sensitive to foreign investors, foreign countries investing in their stock market, if you will.
So they have taken the position that sovereign wealth funds, that is, for our purposes, Alaska, Wyoming, and us, we're the biggest in this country, are part of the US government. We said, we're not, we're just state of New Mexico, we're an individual investor, they don't care. We have the right to freeze your assets, to control your assets, so it's almost impossible for us from a risk legal perspective to invest directly into India as they currently view the United States of America and the federal government, by which Carlos said, clubbing together sovereign wealth funds. So historically, we have tried to get exposure to India through varying products. The most familiar to you of which would probably be ADRs and GDRs. They are receipts that are custodied in American banks, if you will, so therefore we're buying indirectly into India. So I'll also talk about ETFs. That's another way to get exposure to India. But what she's really struggling with and what they're working on is how to get direct investment into India so that they can get closer to the benchmark. And that is the hurdle, if you will. And I think I summarized that, similar to what Charles said, but we're there, it's indirectly, it probably costs a little more because it's indirectly. And we're trying to figure it out, but the hurdle we're facing is a political position taken by the Indian SEC that would put your assets at risk if you went in there directly currently.
Thank you.
Thank you. Anything further, Senator?
Good.
All right, Mr. Treasurer?
Just a follow-up.
Yeah.
Why, I guess it's one for Vance, why do we even want to go into the Indian
Madam Chair, Mr. Treasurer, it's a fairly large market within the confines of emerging markets. And growth rate there is incredible relative to the rest of the world. So the economy is free enough that there's good capitalism in place in India. So there's many companies are growing and becoming bigger. We just can't access it under the constraints that Evan's played out for you. So it's nothing we can ignore. It's in the same boat as China in terms of growth and importance in the emerging market world.
Thank you. Vince, anything further? All right, seeing nothing, we're ready for a motion. Thank you, Linda.
Based on the recommendations of the Council Investment Committee, SIC staff, and the general fiduciary oversight of RDK, I move that the State Investment Council approve a one-year contract extension for international equity manager William Blair, under terms and conditions detailed in today's meeting materials and as reviewed and discussed by the council today.
All right, do we have a second?
Second.
Second by Secretary Olivia Padilla-Jackson. Any further discussion or comment? Seeing none, all those in favor say aye.
Aye.
Aye. Any opposed? All right, let the record reflect the treasurer is opposed. And anyone abstaining? Hearing none, I think the motion still passes. Thank you. All right, thanks everyone. Thanks for your presentations. We're now on agenda item number 4, Finance Matters Committee and Informational Reports. And Brent, the CFO, you up.
Let's go there, we're on page 261 in the diligent material. This is the budget to actual summary for the period ending the end of May. Just wanted to point out here, as I've done in my notes, that at this point in time, and we still have to close out the last month of the fiscal year, we are anticipating that we're going to end the budget year with a surplus. As I pointed out before, any unused budget dollars are reverted back to the funding sources, which is the land grant permanent fund and severance tax permanent fund. Right now, we're kind of reviewing all of our year-end closing processes. In addition to this general admin fund that we have this budget in, we're preparing all of our schedules, we're getting them ready to be prepared for all the funds that comprise the total of the investments on page 267, which is your investment holdings report, the summary page. In addition to the budget schedule, the auditors do look at the land grant permanent fund, the severance tax permanent fund, the tobacco settlement permanent fund, the water trust fund, and the external investment trust funds as it relates to our 21 or so clients. So just be aware of that. On page 286, I did want to point out on the first bullet, the inflows from the state land office relative to both the prior month and the prior year are very strong, and we're very happy to see that because that really helps the land grant permit fund. And then I also wanted to point out, because of the timing of this, on that second bullet, we talked about the monthly beneficiary distributions that we make. We're in the process of, as we speak, doing the one for June. But I just wanted to point out that as we roll into the new fiscal year, these amounts change based upon the 5-year asset average of the related permanent funds times the respective distribution percentage. For instance, in the new fiscal year, and our next meeting will be the new fiscal year, the new amounts will be $65.354 million for the land grant permanent fund and $18.77 million for the severance tax permanent fund. Over the course of the fiscal year, that total will be over $1 billion, as Steve points out. And then on page 287, I'm not sure I'll always point this out, but I think it's really important that I do. The far right-hand total, where you see the book value ending as of the end of May, or I think that's June 1st here. You should be able to take this, and this is basically the distribution part of the ownership percentage of the land grant permanent fund by the beneficiaries. This ties back to the total on the investment holdings report for the land grant permanent fund. I just wanted to point that out. I don't always make that connection. I think it's important too. And then I did want to point out, as we're in the last full week of the fiscal year, just a couple of pending outflows that we have before the ending of the fiscal year. And I think I've mentioned these before, but I think it's important to mention them again. We do have a pending outflow for tobacco of $17.351 million. We'll be doing that over the next, probably over the next few days. That will take place. That amount is actually determined by the legislature and represents about 1/2 of the settlement inflows that we had for the fiscal year. So we'll get that done. And then also pending inflows that we have is $40 million coming in for the tobacco settlement permanent fund. This was determined by the legislature and basically puts back some of the $109 million or so that we had in 2017 when there was some budget stress at the state level. And then the other thing that we have that's going to be coming in before the end of the fiscal year is, and I think this was mentioned at the beginning of the meeting, $175 million as it relates to the severance tax permanent fund. The new fiscal year is just next week, so we have a lot going on in our office, both in terms of closing out this fiscal year, but pending inflows for the new fiscal year, and I think everybody's aware of these. The Tax Stabilization Reserve Fund will have over $500 million coming in toward the end of, or the beginning of July. I would think July 2nd or so. That money's supposed to be there. And then we're also anticipating $1 million coming in from the new rural libraries and endowment fund. Pending outflows in the new fiscal year, we always, usually around the 1st of July, make the outflow for the $4 million that goes to the Water Trust Fund. That's done right away in the new fiscal year. Also, want to point out, and this is my final item, during the August council meeting, we will have the fiscal year 21 appropriation materials. We're kind of into the point now where we're closing out fiscal year 19. We're anticipating activity for fiscal year 20, and then we're doing an appropriation request for fiscal year 21. So it's going to be very busy in the short term in our office, and that's all I have.
Yes, Senator Ross.
Just some clarification. I was thinking earlier, I heard the $175 million would be received in a few weeks. Then I'm thinking, I just heard you said we'll get it this week, or at least we're gonna Are we gonna book it in 19 or we book it in 20?
Member Ross, and that's a good question. It will be booked in fiscal year 19, as I understand it. It should be coming in before the end of the fiscal year. And I think I have email confirmations that that's supposed to happen. So we're making sure that we have all the data flows set up correctly. So
Okay,
it should
so-
be in this fiscal year.
So basically, when I look at the dashboard over the course of 8 years, we've got 355 million contributed. So we're gonna get basically half of what's been contributed the last 8 years this year. Just about to use it.
Very good one.
Thank you, Madam Chair.
Thank you, Senator. Anybody else? All right, thank you very much for that report. We are now on item 5, closing matters. Members, do we have any old business that we need to discuss at this point in time? All right, seeing none, we have some new business. We have a vote on the open meetings resolution. Bruce is going to give us.
Yeah, this is something that this council has to do annually. It approves the way that we comply with the Open Meetings Act. The resolution in front of you is virtually identical to the one that was passed last year. It just provides for notice that we have to give to various people. Senator Ross always complains that we're giving notice through an archaic means, the newspaper. This is by statute that we have to do this. So a lot of this is just statutorily required. The language in here reflects the statute. One thing that we do that we're not necessarily required to do is we have our committees also subject to the Open Meetings Act. Technically, the Open Meetings Act only applies to bodies which formulate public policy. And our committees tend to just make recommendations. But in the interest of full disclosure, we've always had those, I'm sorry, transparency. We've always had those subject to the Open Meetings Act. So that's basically what you have.
Move approval, Madam Chair, of the 2020 resolution for open meetings.
All right, we have a motion, and Scott, we've got a second. Any further discussion on the open meetings resolution? Yes,
I
Commissioner.
had a question, Madam Chair. So I don't see any reference to special meetings. So there's regular meetings and emergency meetings. Does the SIC not have the authority to call special meetings?
We haven't in the past. I don't see why you couldn't call it a regular meeting. There's nothing distinguished in my mind, a special meeting from a regular meeting.
I think it's just not one that has been.
My recollection is that we do have the right to call a special meeting, and I think Lee and I did that 10 years ago. We didn't actually go forward with it, but I think if 5 members asked for it, I believe you can have a special meeting. Maybe Lee, you can have a recollection.
That's what I remember.
And we should have Evan tell us, but not identifying that we have the authority in the resolution to do a special meeting, I don't believe in and of itself says that we can't have a special meeting. All meetings of the SIC should be subject to the open meetings resolution guidelines is the way that I would read that. I want to make sure that I'm correct. I practiced law for 8 minutes, so I like to make sure that I get a second opinion.
Yes, Governor,
Okay.
you're good.
Commissioner, do you want us to make an amendment to that, or? do you
No,
want
I
it
was
with
just
that?
curious because most other open meetings resolutions I've seen refer to special meetings as well as emergency.
We put it in, as I say, it's going to be subject to regular.
Not necessary.
Same sort of notice.
Right, but I think thank you for the question and pointing out, we're looking for consistency. Every body that's got the kind of public membership and impacts public interest, particularly in the way this does, we want to be as transparent as possible. So I appreciate the recognition and the dialogue. All right, so we have no amendments. We have a motion on the table by Treasurer Eichenberg, we have a second by Scott Smart. Any further discussion? Olivia, did I see your hand up? Okay. All right. All those in favor say aye. Aye.
Aye, aye, aye.
Any opposed? Anyone abstaining? Seeing none, the motion carries. Resolution is approved. Thank you. All right, our next State Investment Council meeting will be Tuesday. Remember, we skipped July, August 27th here at 9 a.m. Tuesday, August 27th. We are now on item number 6, public comment period. Mr. Noel, thank you. It's nice to see you.
I'm gonna skip. I just wanted to, Governor and thank you, and Council, introduce Leticia Montoya and Michael Segura, who are now managing partners with InvestMexico.us. We've set forth our INM Oz 2020 fund that we will be funding 5 companies in January. And Governor, I want to congratulate you on the NBC Universal, because that was an opportunity fund project. And I've had conversations with Garcia's, and their opportunity to really expand that area for them moving in with support type companies. Of course, those companies need some infusion of capital. I think it's one of our priorities, because I come from the industry. And so I just want to wish you a great summer and thank you for the opportunity.
Mr. Noel, thank you for the introductions. It's nice to meet both of you. Congratulations on your new posts. And maybe just to end with this comment, we appreciate that you provide public comment, but we are very boastful, and I think we should be as a state, that, we had the 9th best economic couple of months. And that bodes well, and just like the conversations, I don't take that to mean that every single month will be the same, and that we'll never see recessions or any issues where we've got economic downturn, but the more prepared we are, the smarter we are about assessing that and leveraging every minute that we can. And to your point, the Economic Development Department and others, including the Leadership Partnership, which is both rural and urban economic leaders and company CEOs are looking at expanding how we work with and through opportunity zones. So thank you for your continued work, and participating here gives us opportunities in a variety of other venues, and we're grateful. I'm grateful. Separate to this, grateful. All right, well, everyone, have a great July. Thank you very much. I need a motion to adjourn our meeting. Linda, I got a second. Scott, all those in favor say aye. Aye. Any abstain? Any opposed? Hearing none, the meeting is adjourned. Thank you, everyone.
All right, I'll see you back.